Hello, and thank you for joining us today. My name is Tracie Race, and today's webinar is called Tax Planning, a Q&A for personal income tax. Together, we will cover some simple tax planning strategies and answer some challenging questions that come up in conversations with clients and colleagues. Let's introduce you to the women joining me today.
Hi, I'm Kristen Kaminsky. Thanks for being here today. I am an estate planning attorney in Roseville, California, and I work at Maxey Kaminsky Law Firm.
Hi, my name is Gina Mikschel. I'm a financial advisor with Granite Bay Financial Strategy.
Thank you, ladies. And like I said, my name is Tracie Race. I'm a CPA here in Roseville, California. Let's start with the first question from Kristen.
Thanks, Tracie. So the first question is kind of basic. What is the difference between an accountant and a CPA?
Good question. So an accountant is a title that you'll earn if you have a bachelor's degree in accounting. You could work as an accountant at a job where you maintain the books and records and do financial data entry, for example. There's no continuing education requirements to be an accountant. You are what you are because you earned that degree. A CPA, on the other hand, or a certified public accountant, is a state license that you obtain after you've met certain education and work-related requirements and you've passed a 4-part CPA exam. Having a CPA requires you to take continuing education every year, 20 hours a year, and you have to take classes in ethics and fraud in order to maintain your license. There are other designations that you might run across. For example, there are unenrolled return preparers who can prepare tax returns. There are enrolled agents, which is a designation the IRS can give you. And then, like myself, I'm a CPA and I'm also an accountant. CPAs don't just do tax returns. They can also perform audits, comps, and reviews of financial statements. We can represent you in front of the IRS or Franchise Tax Board. And we can do everything that the accountant can do. It's just a designation that we've earned in addition to being an accountant. Thanks for that question, Kristen.
Thanks for the answer.
All right. Gina, did you have a question for me?
I did, thank you. Tracie, when talking with clients, it has become very clear to me that most do not understand how tax brackets work, and I was hoping you could take a minute to explain.
Sure. So I get that question a lot too. As you can see on the screen, I'm going to talk about the 2022 tax brackets as an example so you can follow along. So when somebody says they make $200,000, sometimes they assume, oh, well, I'm in the 24% tax bracket. I'm paying 24% on $200,000. That's not the case. So tax brackets are graduated, and I like to think of them as buckets. So each bucket of income is taxed at a different tax rate. So looking at this slide on the far right is taxable income for a married couple. So their first bucket of 10% tax rate is only up to $20,550. And then their next bucket of income, $20,551 to $83,550 is taxed at 12%, and so on and so forth. They won't be in that highest tax bracket until they have income over $647,000. So it's definitely not all one bucket. These brackets have gotten broader as the tax law has changed since 2018. I will say back in 2018, the highest tax bracket was 39.6%. And you got there sooner. You got there only with $418,000 as a married couple. But now these brackets hold more money in each bucket and are taxed at lower rates than they were in the past. Keep in mind that these are the rates that are in the current tax law, and they could change with the passing of any new tax laws. Thanks, Gina. Did you have another question for me?
I did, and thank you for clarifying the tax brackets. I find it to be a very common misunderstanding. So with regards to minors, though, I do have 2 daughters, ages 13 and 16, and they're starting to babysit more and bring in income from some odd jobs. And I had a question really regarding minors, and when do I need to start filing taxes for them?
Good question. We see this one a lot too. I've got kids the same age, and my son started working this year too. First, I need to give you some definitions in order to answer that question because the IRS doesn't recognize the word minor. you're either a taxpayer or you're a dependent. Dependents are typically your children under 18, or if they're still a student, under age 24. But you could also have a dependent that's like your elderly grandma who lives with you and doesn't make enough money to support herself. So let's clarify what a dependent is. We're going to talk about your minor children as dependents. Then we're going to talk about the difference in what type of income they're earning, because there's unearned income, which is interest, dividends, and capital gains from investments. And then there's earned income, like what you were referring to, small jobs, babysitting, that's considered earned income. So if you have a 16-year-old that works at Sunsplash, for example, and they made $15,000, they're going to have to file a tax return because their income was more than $12,550 in 2021. So that threshold for earned income is $12,550. But the other thing that catches parents is that unearned income category. So say they have an investment account and they've earned interest and dividends. If those unearned income amounts are greater than $1,100, they'll have to file a tax return. So that's the scenario that catches more kids sooner. Grandma put some money in an account for them. They've earned $1,500 of interest. They have to file a tax return. And furthermore, the way that a child is taxed matters. If they're under 18 and they're your dependent, let's say for an example, you have a child who has unearned income of $3,000. That first $1,100 is tax-free. Their next $1,100 is taxed at 10%. It's called the kiddie tax. And then anything over those first two $1,100 buckets again is taxed at the parent's tax rate, which catches a lot of people. And it caught me this year. My son had the same scenario. He sold some stock, he has a gain, and he's going to pay tax on his capital gain at my income tax rate because he made more than $1,100 in unearned income. So good question. I'll let you know that these amounts change a little bit every year. They're graduated for inflation, and the 10% tax rate could also change depending on the legislation. Thank you. All right, let's talk further about children. Kristen, did you have a question for me?
Yeah, Tracie, could you go into a little bit of detail about the child tax credit in 2021, and are we expecting to see it in 2022?
Sure. Yep. This was a change for 2021. Unfortunately, it is just for 2021. So I'll give you the bad news up front. The child tax credit increased from $2,000 to $3,000 for 2021, and an additional $600 if the child was under 6. And furthermore, the IRS could have advanced you up to 50% of your child tax credit. That advance was based on your 2020 tax return. So you did have a scenario where you could opt out if you didn't want to receive the advances. And the IRS is sending out letters letting you know how much of an advance you had received. But the IRS have said some of those letters could be incorrect. So they advise you to go onto their website and verify the amounts that they say they gave you and compare that to your own records. A little more bad news. So these credits, these child tax credits are phased out if your income exceeded $400,000 as a married couple or $200,000 for a single individual. So there could be scenarios where you received an advance, but you might have to pay it back either because your income was too high, or say for an example, you don't claim that dependent every year. Say you have a divorce situation and dad claims her 1 year and mom claims the child the next year. Dad might have to pay that advance back and mom would get to claim it on her 2021 tax return. So it's definitely a little tricky area this year. It's going to give tax preparers a little bit more work to do, and then the taxpayers will have to be able to give those documents to their tax preparer. So definitely tricky. Thank you for the question.
Thanks, Tracie.
Gina, did you have a question for me?
Sorry about that. I did, and this actually relates to Social Security. I wanted to ask if you could take some time to discuss how Social Security income can be affected if a spouse passes away, And I do believe this is critical just for those who are budgeting on a fixed income and also to plan for future unknowns, especially as women continue to outlive men. I think it's important for them to know how their Social Security may be affected if someone does pass away unexpectedly.
Great question, Gina. Thank you. I learned about this firsthand when my grandpa passed away a few years ago, and I had to help my Nana navigate through this exact scenario. So when your spouse passes away and they were over 60 and collecting retirement benefits, you could be entitled to survivor's benefits. And you're only going to receive the greater of the survivor's benefits or your own retirement benefits. So you will not receive both. Social Security will work with you to look at what your spouse was receiving in benefits versus what you are receiving, and they'll give you the greater of the two. Just like your regular Social Security retirement benefits, it's a stable source of income that you're going to continue to receive until you pass away. There are scenarios when people other than a widow can receive survivor's benefits. Say, for example, someone passes away and they had minor children under 18 or 19 years old, or a little older child that was disabled. They could be able to receive survivor's benefits as well. There's even a scenario where your ex-spouse can receive your survivor benefits when you pass away. So say you pass away and more than 10 years ago, you were previously married and that spouse is still unmarried and not collecting retirement. That ex-spouse can receive up to 50% of the deceased person's retirement benefits. So I don't know how they notify you of that. I guess you have to know when your ex-spouse passed away, but you should definitely reach out to Social Security if you run into that situation, and they can help you navigate how to get those benefits as well. Gina, good question. I agree. It's definitely important for people to understand the sources of income that they have moving forward.
Yes, I think with Social Security, it's been really sad to see sometimes a husband and wife are both bringing in $2,000 a month in Social Security, and then they learn, unfortunately, once one passes away, they only get to keep the greater of the two. So their monthly income went down from $4,000 down to $2,000, and they did not plan for that. So it's important for people to know this before it becomes an issue. I did have another question regarding 1031 exchanges, so not related to the Social Security, but definitely a very timely question today. And with real estate values so high, I have found that we do have many clients who are wanting to take advantage of these high prices and sell their investment properties for real estate. And there's also ways to defer the taxes on the gains known as 1031 exchanges, but I find that a lot of people do not understand exactly what that is, and I was hoping you could explain that.
Sure. So a 1031 exchange is a vehicle that people can use to exchange one property for another. So say, for example, you own a rental that you no longer want anymore, but it's appreciated significantly in value. You don't want to pay tax on that appreciated gain. With a 1031 exchange, you can roll that gain into a new property. And new property meaning if you're selling a rental, you will purchase another rental type investment property. And that could be another, if it was an apartment or a house, you could buy another apartment or a house, or even other vehicles called DSTs, which I won't get into, it's a little complicated. So, but there are ways to exchange from investment property to investment property, let's say. So the way it works, I have a nice formula. I like numbers up here on the screen for you. You take the sales price of the property you're selling, and you subtract what you originally paid for it and your selling expenses, and then you come up with this realized gain. And then you go identify a new property and say the cost of that new property is $2 million, and you're trying to defer a gain of $1 million. Now your basis on this new property is $1 million. So you've deferred gain, tax on that gain of $1 million. There are caveats when you do a 1031 exchange. You need to use an exchange intermediary to do it. You're not allowed to touch the proceeds. This exchange intermediary will charge you a small fee, and they'll be the one to facilitate the proceeds coming from the sale of the first property and going to the purchase of the new property. A couple other little caveats: if you receive any cash out of the exchange, you'll pay tax on the cash that you receive out. It's called boot. And then there are also timelines as to when you identify that new property and how long you have to close on it. So the exchange intermediary will work with you and help you meet those guidelines, but it's definitely a good vehicle to defer gain in property that you no longer want anymore. And another key piece of information when it comes to taxes is, say you've just purchased this $2 million property and you deferred $1 million of gain. If you pass away today, your heirs inherit that property with a basis of $2 million, and they never have to recapture that gain that you deferred. It disappears under their eyes. So great way to defer tax and hopefully never pay tax on that gain. Great question. Let's see, Kristen, I think you had one more question for me.
Yeah. I was wondering your thoughts on filing a 645 election for treating a trust as an estate after the death of someone when they've got a revocable living trust.
Yeah, sure. I can answer that question and we can see if we're on the same page. So when you pass away and you have a revocable trust, it becomes irrevocable. And that trust can decide how they want to be treated for tax purposes. So if you make a 645 election, you're telling the IRS, I want to file one tax return. I want to be done within a year. All my assets are going to be distributed. They don't have to be sold, but distributed to these beneficiaries, and then we're done. There are benefits to filing a 645 election when it comes to tax purposes as well. For example, there are charitable donation set-asides that you can report on the estate tax return, and you don't have to make estimates for the first 2 years on an estate return that you would on a trust. There are higher personal exemption limits on the estate tax return, and you can choose your calendar versus fiscal year as well. So say, for example, you pass away in October. If you didn't make the 645 election, you would have to file a trust return for October to December, and then another one from January until when you're closing the trust down. So typically, I would rather make a 645 election, and I typically see these when the value of the estate is low, definitely below the $12 million estate exclusion, but I typically see 5 million of assets, and then trusts that only have a few beneficiaries where they all get along, they all know how the assets are going to be distributed. There's not going to be anything that holds up the filing of the tax return and the closing down of the trust. That it's not going to take more than a year. So is that what you see too as well, Kristen?
It is, and that's how we generally file for our clients, is we do generally utilize the 645 election because we've just found that it does make the whole administration a little bit simpler to file that one tax return.
Yeah, and there are a little tricky areas when it comes to preparing the tax return. Like, for example, you're going to get a 1099 for interest and dividends in December. Well, your 645 estate tax return is not going to end in December, for example. So you just have to get monthly statements to figure out what income is included in that estate tax return. It's not hard. It's just more paperwork. We like paperwork. So
thanks, Tracie.
Yeah, thanks, Kristen. Well, that's all I have for you today. Ladies, thank you for the opportunity to answer your questions. I want to mention that Krista Kinsman, she's the other woman in this group presenting the webinars with us. She was unable to make it today, but I wanted to mention her and let you know that she'll be joining us next time. If you have any questions, feel free to reach out to any of us. We're happy to assist you with your financial, tax, fiduciary, and legal needs. We offer complimentary initial consultations to anyone who registered for today's webinar. Our contact information is on the website that you use to register. Thanks again for joining us, and we hope that you will join us next time for next month's webinar discussing investment basics. Thank you.